You are listening to Benzinga's Pre-Market Prep. I'm Brianna Valesky here with Joel Elconin. We've got Todd Sullivan on the line. He's the founder of Rand Strategic Partners, a long-short hedge fund. He's also the author of the ValuePlays blog and an angel investor in Estimize DailyWorth, Mile High Organics, Shatki, and other places. Todd, how are you doing this morning?
I'm great, thanks. How are you?
We are fantastic. It's a great Tuesday morning here in Detroit. Now, I want to start with you and I have talked a lot about all that's been going on with Whitney Tilston and Lumber Liquidators. Can you give our audience just your general view of the situation right now, what's going on with the company, how you feel about Whitney Tilston coming out so publicly about his feelings while he's also short on the stock? Just an overview for our audience would be great.
Well, as far as someone talking their book, I actually prefer that to the people who allege to have no bias and no opinion on any kind of subject, right? So if Whitney Tilston's short, he comes out with a short thesis. At least I know where he's coming from. At least I know his bias,
Right.
versus someone who says I have no stake in it either way, but this is what I think. Everyone has a bias, and it's better when it's up front.
That's a great point. Yeah, absolutely. He's been really honest about, that he's short in the stock and this is how he feels about it. Do you agree with his statements about Lumber Liquidators and everything that's been going on about it?
Well, it's funny. Lumber Liquidators at no point in time has denied any of his allegations that formaldehyde levels in their wood are too high. They've come out and actually admitted they are, right? They said that, some of the recent tests that were done showed elevated levels, and what they're complaining about is the test method, not the results. So,
Right.
and then there's a lot of controversy over how this specific test method is done and what labs that are doing them. So, I think Lumber Liquidators is in a tough spot because we saw their recent Q1 update. Margins collapsed. Profits were down. Sales were down, maybe 12, 13% in March alone. And a lot of that was due to customers not wanting the Chinese laminate flooring. So, there's a link to their margins going up so spectacularly the last few years on the sales of this Chinese laminate. And just from a business perspective, if you take that out, their results are going to be a whole lot worse, irrespective of what happens with any investigation the next couple of years, as margins go back to more normal historic levels, sales for this laminate fall. They're not going to earn anywhere near what people think they are.
Do you think after this all kind of pushes over, investors are even going to care? I've talked to a couple traders who think the stock is worth where it was before it started to fall, and that this is all just kind of going to blow over and it'll move right back up to where it was before this news started coming out.
I don't think so. Regulators are kind of tough to figure out, and oftentimes they are not moved to action until forced to action. And when you get a public outcry and something like this, and you get 60 Minutes investigating it, and I'm sure 60 Minutes will do a follow-up down the road at some point about the testing procedures or any kind of results, then you have to wonder if they start putting some restrictions on the importing of this wood. None of the U.S. mills that produce this wood have these high levels. So you're going to start getting trade association pressures. Probably a couple of congressmen who live in states that have these American factories are going to get involved. So there'll be some pressure on regulators to do something about it. And bottom line with Lumber Liquidators is without this Chinese laminate and without the well above industry average margins it produces, their results will not be anywhere near what they have been in the past. So if that's true, then the stock, if it does go back to those levels, and I don't predict stock prices, it would be grossly overvalued, given the business prospects for the company itself. So, and I do think the company, if you talk to contractors, and I've spoken to a couple of the ones that I know, there is a negative bias towards the company, even here in New England, and they're founded here. Todd Sullivan's a New England guy, and I think it's going to be a problem down the road. That doesn't mean traders could bid it up, or you could get trading on the news, that could make the stock whipsaw all over the place. But as far as a valuation-based level based on the past, I don't think that's in the cards, at least not for the next couple of years while this stuff. It's going to take a while for regulators to do anything. So until this is settled, I don't see the company doing much of anything. kind of like Herbalife right now. Herbalife is kind of stuck in this range until some sort of results come out either way with the FTC or Justice or whoever.
Right, that's a great point. Just comparing it to, I mean, same story with Herbalife. We have Bill Ackman, who's constantly coming out, and he's publicly short on the stock. We have Alcoa reporting earnings this week, the unofficial kickoff to earnings season. I've heard a few people say that they think that it's going to be a light, if not negative. We're going to see light, if not negative, results from people reporting for Q1. What's your outlook for earnings season?
Q1, this winter will affect Q1. Now, I know people on the other side will say, well, yeah, it's winter. It was cold and it snowed. It's cold and snows every winter. The fact of the matter was this is a record-setting winter in a lot of parts of the country. It has never snowed as much as it snowed in New England this year, and it was never as cold as it was, at least not in the last century. So I think to assume that because you had a record-breaking winter that there won't be some sort of drag on earnings and GDP, I think it doesn't fly in the face of history. I mean, if you go back to winter of '93, we had that storm of the century, and GDP in Q4 was running about 4%, and Q1 '93 dropped to 0.8%. So winters and severe large-scale storms that affect the majority of the eastern seaboard have, in the past, had large effects on earnings and GDP. There's no reason to expect this won't be any different. The good news in that is that it's a one-off event, right? It affects it for Q1, and then there's usually a catch-up in Q2 and some strengthening throughout the year. So, and I imagine even the West Coast port strike will have some effect on earnings for Q1. So I don't know if I'm in the negative camp. I don't think the earnings growth will be as robust as it has been, but I also don't think that that's a permanent condition or anything to worry about. And in fact, if you do get some sell-offs in certain stocks because of earnings, you may end up finding yourself in a fantastic buying position if your outlook is more longer term over the next couple of years.
That's a great point. You're absolutely right. It was a record-setting winter, and I'm certainly glad that we're moving past it. I'd love to get kind of your long and short-term outlook for some specific names that are just pre-market movers or big guys overall. First of all, Apple. I mean, the watch, there's been mixed sentiment regarding the watch. Would you buy an Apple Watch?
I don't own a watch, and I haven't owned a watch in probably... It's been over a decade since I've owned a watch and wore a watch. Mm-hmm. But I actually am curious enough in this that I would actually consider. I don't think I'd buy one out of the gate. I think I'd wait for maybe the next one or something like that. But I actually am considering buying a watch for the first time in, like I said, over a decade. So as far as Apple goes, I think Apple is just scratching the surface with its Apple TV and what they're going to eventually do with that. If you're someone with a long-term outlook, I would have a hard time arguing for someone not buying Apple. I mean, they are clearly the dominant player in whatever they touch, and they have the highest quality products. They sell them at a premium price. They get it, and there's still excitement around every launch that they do, and noticing more and more Windows-based, Microsoft-based organizations going to Macs simply because of the ecosystem and how they can tie everything they do into it easily, seamlessly, and what's next for them, right? Where is the software going to go? Is it going to start going into cars? And I'm long-term extremely bullish on what Apple can do, and I think Tim Cook has proven himself. There's a lot of skepticism on him when he took over, and I think he's taken the company a lot of directions that are pretty exciting.
What about another tech giant on our radar, Google? I know they've been having problems with legalizing and their monopoly issues in Europe, but they haven't had anything like that over here. What's your long-term outlook for Google?
There's no one close to what Google can do in terms of search. So they are going to be the dominant search engine for at least the foreseeable future. At some point, something might come along down the road, but it's going to be a tremendous mountain decline to get over them. I think the issue that I would have with Google is they tend to run in a million different directions, and the directions they tend to run in aren't always based on a return of that investment. They do a lot of experimenting with their money. They do a lot of experimenting with things. Now, they are, in some respects, a giant angel investor with a lot of their VCR and stuff like that. But again, when you're that size, even if you hit on a regular basis, I'm not sure it's a needle mover. So, a lot of things they do aren't necessarily going to show up in the bottom line and show up quarter-to-quarter earnings. But again, I would have a really hard time betting against Google simply because they're brilliant people. But I don't know that where it is now, if I would want to initiate a long position, maybe if they stumbled real bad one quarter and the stock got axed real hard, then it would become more appealing. But I think, it's hard to kind of tell it's hard for me to estimate what they're going to do given the multitude of directions that they run in and the lack of disclosure in a lot of those directions. Not that there's anything nefarious going on. It's just that, they're experimenting in this, experimenting in that. It makes it hard for me.
Todd, we know you're a strict value investor, and you like to look at things that are at a discount to intrinsic value before you're making, your purchases. I mean, what particular factors are you looking at? Are you looking at, the amount of cash that they have on? Are you looking at PE, forward earnings projections? Without giving away your secret sauce here, what are the primary things you look for when evaluating a stock at, whether or not it's a discount to its intrinsic value?
I don't really look at PE value much anymore. And ever since FAS 157, where everything in the world is marked to market, I think PE has lost a major part of its valuation usefulness. Earnings in a company can vary wildly quarter to quarter based on some of these non-cash charges or non-cash benefits, while the core earnings really don't change that much, right? So that kind of makes your PE values, if you're comparing them year over year or 5 years ago to now, makes it almost irrelevant. So I like to see cash. I like to look at debt levels. I really like looking at the balance sheet because earnings can be dressed up and down pretty easily quarter to quarter. It's a lot harder to screw around the balance sheet, I always say balance sheet's the heart of an organism, and the earnings are the skin. It's easy to make your skin look bad, make your skin look good, but it's real hard to change what's on the inside. And I compare a lot of, so if I'm sector to sector or company versus company, I'll compare and look, and I'll look at where they've been historically, what they're doing now versus then, and see if I can determine how they're valued based on what they've done in the past and what their competitors are doing. And then hopefully there's some sort of event in the future, whether it's current litigation, upcoming spin-off, an upcoming merger. There's something that the government, investors aren't quite giving the full benefit for. And when that event happens, I think it's going to be an impetus for the stock going up rather quickly. So. Easy example is AIG is getting ready to sell their stake in AER, the company they sold their flight division to. That's going to net them about $4 billion. They're going to raise about $6 billion this year in non-core asset sales. And I think all that's going to go into a buyback. I don't think the market's anticipating that or believes it's going to happen until they announce it. But everything they've done in the past indicates that they will, and I think when that happens this year, the stock sees a pretty decent bump. So things like that I tend to look for.
Okay, we got an upgrade today of J.P. Morgan. There was some bullish ink in Barron's a couple weeks ago. Can you give us your outlook? I mean, here's a bank stock, kind of a slow mover, but does this fall onto your buy radar?
I don't own J.P. Morgan. I own Bank of America. I think it's significantly cheaper to own than J.P. Morgan. I think its litigation problems are largely behind it, and I think that over time, its core earnings capabilities are going to come to the front, and the stock will at least get itself back to book value.
And what is the book value? What is the book value?
Last time I looked, I think it's 22, 23, so it's still a significant discount to book value. Versus J.P. Morgan, Wells Fargo, they're all trading at book or above. So just on a valuation level, it's much cheaper. And given this history of litigation and bumps and stuff like that, it's kind of deserved that discount. But I think most of that's behind it. I think Brian Moynihan's done a fantastic job. And what people have to realize is that when Berkshire Hathaway converts its warrants that it got in the company into shares, Bank of America is going to be one of Berkshire's largest holdings. So I think that says a lot to the confidence at least someone like a Buffett has in Bank of America and what Moynihan's doing there. So, but the whole banking sector, I think, it's being dragged down by Dodd-Frank and the mortgage issues and the putback risk. And I think at some point, some of those issues from either congressional or regulatory action are going to have to be relaxed, and more reasonable metrics are going to come into place, and I think that will unleash more of the mortgage market that still is incredibly restrictive in lending, and I think you can see bank earnings in the next couple of years really start to impress people to the upside, and I think the whole banking sector, at least the big banks, can really start to benefit from that, because mortgage lending is still too restrictive. If you're around 700 credit, good luck getting a mortgage. And, historically 680 has been what Fannie and Freddie were buying. And that's 740, 750 credit scores right now is what Fannie and Freddie are buying. And that eliminates millions of people from the housing market. So, and it's the typical overreaction to an event, right? You gave anyone with a pulse a mortgage from 05, 06, 07, and now, you got to give up a child to get a mortgage. So there's a typical pendulum swings too far the other way, and eventually it settles back to more reasonable levels. And I think, the banking sector, and, J.P. Morgan's perfectly positioned there. I think they'll all really benefit from it.
All right, one more for you. American Express, kind of been in the doghouse since Costco dropped them as an exclusive credit card. What do you think? Any value here in AXP?
It's funny. American Express used to have this sort of, I don't know what's the right word, cachet with it or something about, you had to have American Express card. And I don't think they have that anymore. I think they've lost that. I think some of the banks have come out with their own, Platinum or Ink or whatever these cards are that offer, lots of benefits and privileges and things like that, kind of matching American Express. And Amex is kind of still doing what they did 10, 15, 20 years ago. I don't see a whole lot of dramatic changes to their cards or their program, and while everyone else is kind of caught up to them. So I don't know if there's tremendous value there, because I don't think the outlook is as clear to them as it used to be. I mean, losing the Costco thing was a big deal. I think people are rightfully worried. Well, are there other deals they have that might fall apart also? And if they do, what does that mean for the future of American Express? So I think the future is a little cloudy. I wouldn't say it's negative or bad, but I think it's hard to say it's a tremendous value at these levels when you really don't know what's coming up. And the competition has really closed the gate. I mean, having an American Express Platinum card isn't a big deal anymore, whereas 10, 15 years ago it probably was. And I don't know if maybe Amex saturated that market, so everyone has one. But there are certain other cards from Chase and the banks that do have a little bit of privilege to them that I think American Express is kind of suffering from.
We've been on the line with Todd Sullivan, founder of Rand Strategic Partners, joining us here, the long-short hedge fund manager and author of the ValuePlays blog. Todd, thanks for your insight into the market. We hope to have you on again soon.
Thanks, Todd.
Anytime.